I do want to highlight what we've been talking about over the last week when it comes to banks, and this is a lending slowdown overall. This is total loans with a one-year growth estimate, and JPMorgan is down by about 4%. The other banks, though, faring much worse, in particular Wells Fargo, almost at zero. Walk us through what we're seeing here. Core loans up by about 7%, the average core loan. Where does that leave us in terms of lending growth?
Well, I think, again, it's important to dig into the numbers. So having not looked at it, like C&I growth has been sort of the bigger worry for the industry. Commercial and industrial loans have really led overall growth for the banks since the crisis, and that's been slowing over the last couple of years. Some of that is just tighter underwriting. And then some of that in the most recent quarter, as I said, is customers tapping the capital market. So JPMorgan's been generally outpacing the industry. We're going to look and see that category. The other part of it is the consumer loans, as we were just talking about. So consumer has really picked up. Auto lending has been sort of a relatively bigger driver. Banks have started to pull back from that. But card has really been accelerating. And, that's really where a lot of the banks are sort of fighting the market share war. And so going to look and see how those sapphire balances are coming.
I want to bring in Jay Pelosky, Pelosky Global Strategies founder and principal, who is bullish on the financials. Jay, great to have you with us around the programme. A stroke of genius from Jamie Dimon in the last month. He had us all talking about Bitcoin and not about plunging trading revenue. But here we are. We have to talk about the numbers. Give him a chance, and I'm sure it'll change the narrative around these numbers as well. What do you make from what you've heard?
Well, I think first off, for Jamie, he's taken a lesson from the president, right? Say one thing and listen to what I'm saying, not what I'm doing. But on the banks, look, I think it's pretty simple. To me, banks are a hedge with upside. And they're a hedge against rising rates. And that's one of the concerns for stocks in general. Can they do well in a rising rate environment? They have upside because of regulatory action. I think you're seeing the easing of Dodd-Frank, and I think that's likely to mean a return of capital. And that's what investors want, right? This market has been built on return of capital, share buybacks, dividends, et cetera. And I think what we're going to see from the banks over the next year or so is significant return of capital. So you have a hedge against your main worry, which is sharply higher interest rates. Banks benefit from that, unlike most of the rest of the market. And you have upside from regulatory relief. And I think that combination of those two is pretty attractive.
So who's going to benefit the most, looking at the big players?
Well, that's tougher for me. As you know, I focus mostly on ETFs. I would stay mainly with the main banks. I don't really have a view of one individually versus the other. To me, what I've been looking at is U.S. banks versus European banks versus Asian banks. And there the play has been outside of the U.S., as it has been for most of the sectors in the stock market. The upside has been in European banks. They're up 30%, almost double the performance of the U.S. banks. And I think there, too, they have regulatory relief in the non-performing loan side. So banks in general, not just in the U.S., but globally, I think banks are winners from regulatory environment and they provide protection against rising rates, which is one of the big concerns as we go into 2018.